So this is Chapter 8, Part 4, just to finish up on our example. What we were doing is looking at the second method of calculating bad debt expense, estimating bad debt expense for our adjusting entry. The first method was in number 4, where we used percent of net sales to calculate our bad debt expense. And there we just took the sales amount of $200,000 times 2.5% to come up with $5,000. We recorded that entry as bad debt expense, $5,000. That's what shows up on the income statement. Credited the allowance for $5,000. We had a $1,000 balance, debit balance in the allowance account prior to that entry. So we ended up with a $4,000 balance in the allowance account that would be deducted from our gross accounts receivable. Looking at the second method, which is the accounts receivable analysis method, we found that by going through our accounts receivable, we determined $5,000 are uncollectible. So what we want to do is we want to make sure our ending balance in the allowance account reflects $5,000, because that's what we want to deduct from our accounts receivable. So this balance has to be $5,000. Now, we can't just make an entry for $5,000 because we already had beginning balance or balance before our adjustment, which was a debit of $1,000. So when we make that entry, debit bad debt expense, credit the allowance, that credit to the allowance amount is going to have to get us from $1,000 debit to credit of $5,000. And so the only way we can get there is by making a $6,000 credit entry. So that allowance amount is going to be $6,000, and therefore our bad debt expense in this case would be $6,000. So we're going to end up with two different answers based on these two different methods because we had a beginning balance in our allowance account or a balance prior to that adjustment, a debit balance of $1,000, and that's what's going to make that entry different. In fact, $1,000 different because of the way the two methods work. So hopefully that makes sense. But again, and then that would be those adjustments using one of those two methods would be made at December 31st or whatever the period end is. And then again, we'd start over with the next period with any write-offs or any reinstatements and collections that were made to the allowance account. And then at the end of the next period, we'd make a similar adjusting entry to record bad debt expense. So I think it's worth noting that the only time expense is ever recognized is through an adjusting entry, okay? So the only time we ever have an expense is through an adjusting entry. So expenses are only recognized through the adjusting entry, and that write-offs do not give rise to an expense. As you can see above, the expense is already recorded when we make our adjusting entry and make our estimate for bad debt expense at the end of the period. After that, no more expenses are recorded. So all these write-offs, when we actually write the account off, there is no expense entry. All we're doing is shifting the amount from the allowance account to eliminate the accounts receivable. We've already recognized the expense. So when it comes time to write off the specific account, we've already recognized that expense previously when we made that estimate. So all we're really doing now is just determining which account is to be eliminated, and we're just removing that from our accounts receivable ledger and then taking that out of the allowance account. So those are two key items to remember. Expenses are only recognized, bad debt expenses only recognized when we make that adjusting entry at the end of the period, and write-offs do not give rise to expense. We've already recognized the expense here at the adjustment point. The write-offs are simply to remove those accounts from our accounts receivable ledger.